Well, I'd just like to welcome everybody then to the second Berry and Oak webinar for 2022. We hope you find this a useful webinar. We did want to do it on a face-to-face basis, but we really struggled getting a venue because there's so many weddings going on that are catching up from the COVID years. So we struggled to get a venue that we would have liked to do the event at. So we're doing it virtual this time. So it's going to be available to watch afterwards and for you to share with any friends and family that you would like to view it. I think it's obviously a very timely time to do a webinar when we're going to talk about what's happening about investments, both so far this year and the future, with what's gone on in the stock markets in the last few weeks and months, and all the events around rising prices, oil prices, the war in Ukraine, etc. So just a little bit for today that we'd like to sort of go through and share with you. Just remind you, obviously, your microphones and cameras are automatically turned off, so we can't see and hear you. You'll just be hearing from myself, Sarah and Shane. Any questions that you've got, I'd like to say thank you very much to all those that have sent questions to us before. They've been very helpful, and we're going to be sharing those and asking Shane to answer them during the course of today. And also there's a couple that I'll be answering as well. If we don't get a chance to answer all of the questions, we'll try to do it at the end of the session and we'll come back to you. If you've got any other questions you'd like to ask, please use the Q&A section and we'll do our best to answer them for you today. And if not, follow up for them afterwards. Also, just timing for today, I'm going to spend a few minutes just going through what's been happening at Berry and Oak, and then going to pass you on to Shane to sort of give you an update what's happening in the economic world at the moment, what's happened to the portfolios, and more important, for him to get his crystal ball out and what does he think is going to happen going forward. After the event, just like to remind you that as you leave, you will be prompted to fill in a short survey. It'll only take a few moments, and just your feedback on the event today and how it's gone, what value you've got from it, and what you would like for us to do in the future that would give you more value and help us shape the events and what we do to help you with your financial planning journey. So moving on to what we've been doing in the background, and we've been doing quite a lot of work to sort of make sort of financial planning accessible to more people, because we know that there's still a lot of people that aren't having the opportunity or time to sort of sit down and look at their financial future. Yourselves as clients of ours will have already gone through your financial planning, but it's for those people that aren't yet on that journey. So we've helped supply and wrote the foreword for a book called Enough, which is designed to help people understand what they need to do in their financial planning and understand when they've got enough to be able to do all the things that they want to do with their life in their lifetime. It's a book that's free to download from our website. It's on the tabs at the top from there. All you got to do is put an email address in to get free access to that book. So if you've not read it yourselves already, by all means go get a copy yourselves, or if you know anybody that, family or friend or loved ones that you think would benefit from this, then send them a link to the website and let them download their own copy free of charge. We also know with all the things that have gone on in the last few years, people are starting to look at their own financial planning and what it is that they need to do to make sure it works for them. For those starting off the journey that have not yet worked with a financial advisor, we've got a free financial planning tool available on our website called Truth About Money, where they can input their own detail and using some generic assumptions on there and items that are able to be adjusted, they can have a snapshot look at what their own financial plan might look like. If they then need to get further advice, they can speak to a financial planner about that. But for some, it might be all they need to get the journey started and make some changes to improve their financial well-being. So again, feel free to share that with anybody that you think would benefit from it and get them started on their journey towards financial planning. A lot of clients have used it for their sort of children or grandchildren and sort of family members to get them started with financial planning. And then we also are writing now a number of different guides, usually about 10 to 12 pages with plenty of pictures to make sure it's easy to read, on different topics of financial planning that make it try to sort of answer in sort of clear language some of the questions that clients will typically have in these areas and help people sort of self-manage and make some guidance on what they need to be doing. So to say, we're trying to do at least one a month. At the moment, some of our most popular ones are investing for your children and grandchildren, financial protection, estate planning and inheritance tax planning, what you need to do to be ready for retirement, and also sort of later life financial planning, especially around things like long-term care. So they're free on our website. If you find any of those of any use, just download them and share them with anybody that will find them benefit. So hopefully you'll find those good. Also, with ourselves at Berry & Oak, as you know, we've been very fortunate with the number of awards that we've won. And we do like to enter the awards because it helps us look at where we are as a business and what we can do to improve, and make sure we're delivering the best service and support to our clients on their financial planning journey. So this year we entered 3 awards at the Yorkshire Financial Awards, and we're sort of stunned to walk away with a sort of clean sweep, winning the Financial Advisor of the Year. Sarah also won the Director of the Year, and the team won the Financial Advisor Team of the Year. So that was, you know, an amazing event to be at, and we were quite shocked by it all. We also won the Citywire New Model Advisor of the Year award for the North of England, something that we've won for the 4th year in a row, which is incredibly pleasing for all the hard work that the team do, looking after yourselves as clients, but also takes into account what we're doing with graduates, training in schools and other work in the community. So that's been, you know, a very pleasure to be awarded that one again. I also had a trip down to London a few weeks ago to visit the House of Lords, where I was highly commended for the work we do as best financial planner, especially in the enterprise investment scheme space. It was, you know, being inside the House of Lords was quite an amazing experience. And I think the team have now got a new nickname for me of Lord Elson of Towton. But I think I'll probably stay as just Andrew for now. But I think the best award that we've had so far this year was the Intelligent Office Super User of the Year award. And this is where Diane, pictured here with her best friend, Gabby Logan, was invited on stage to receive the award on behalf of the Berry & Oak team. Intelligent Office is our back office system that we use to produce all our client data, gets all the valuations on your plans, and it's what powers the personal finance portal that you have use and have access to. So to win the award of their super user based on how we're using it, the training and development that we're doing on it, was absolutely fantastic. And that's, you know, something Diane and her team should be really proud of. And I know that she really enjoyed the event. Moving on from there, though, just wanted to give you an update on some changes that were happening shortly on some new team members that are joining to help and sort of serve you on what's needed. So after the success of our 2021 graduate scheme that we launched, we've got a new class of 22. We had, you know, quite a number of applications for this one, so it was quite tough going through the process to choose what we thought would be the right people to join us. And I'm pleased to announce that we've got a young girl called Tahira, who's joining us on the 12th of July and starting her journey in the financial planning profession. But then we've also got a young girl called Lily May joining us in early September. Now, I have to make sure that it's clear that her name is going to be Lily May, because you all know we already have one Lily, and more than one Lily in the team could cause confusion. So it's Lily and Lily May that we have going forward. And I know that they're both looking forward to starting work with ourselves and being able to help you, our clients, in their financial planning journey. On top of that, though, we've got another name problem coming up, and that we have another Andrew joining us. Andrew B is going to be working as a financial planning analyst with us, and his job is going to be doing the research and analysis, helping to build our clients' financial plans, and also do the research and all the different investment offerings that we've got available on it from there. So Andrew will probably be sitting in a number of the meetings as well, so you could have a double Andrew experience, and we'll have to think of an alternative name for him so we can distinguish when people get in touch which Andrew that they want. So look forward to Andrew joining us as well from there. And then The other bit I just want to talk about is obviously with rising prices and cost of living going up and inflation, people are being concerned what will happen with their financial plan. Now, obviously oil prices and sort of supply chain rises in prices have had an impact in prices and the eventual cost of goods. And this is going to differ depending just where people spend their money on, where the expenditure goes, but also where their income comes from and, how that is affected by inflationary rises from there. So I think it really is going to depend as well whether inflation is going to be a short-term concern or a long-term problem. Now, when we do the financial planning with our clients, typically we use a rate of return of 3% for inflation, which we think over the long term is a good average to be, especially when the government has got the Bank of England targeting 2%. So we're assuming it's going to be 1% more than the Bank of England target. When we look back over the last 10 years, inflation has ranged from 0.7% to 2.8%. So even the highest level before this year was lower than our assumption we made for every year. And the average over that 10 years is a return of 1.82% for inflation. So when we're assuming 3%, we are assuming inflation over the long term is higher than it actually has been. If we factor in 1 year at 10%, it still takes the 11-year average then to be 2.56%. Still quite a bit below the target that we're using over the longer term. So it takes a few years of much higher rates of inflation to make an impact on the long-term inflation figures. And it's our feeling that the inflation is going to be more of a short-term, 1 or 2 year problem at most, rather than being a longer-term problem. So what we will be doing at your next financial planning meeting, we'll be going through this with you and reviewing your financial plan, looking at the inflation figures that we have used, but also looking at different rates of inflation and how that will impact your financial plan. And I'm pleased to say that those clients we've done that with recently, it's not had an adverse effect that means their financial plan doesn't work. So when we see you next, happily to go through that with you and make sure that it's not going to be a problem for yourself. But I said our best case that we're looking for at the moment, our base case is this inflation probably is likely to be a short term and longer term. Bank of England trying to get the rate back down to 2% and stick to there, then our assumption rate of 3% is still actually very cautionary to use. And then obviously there's the bit about rising interest rates. Interest rates are going up now. For savers, they'll probably be pleased that at least they're going to get some return on their money, though the key bit still is, are you getting as much as inflation, especially over the sort of medium term? There are some quite interesting 1 year fixed rates at the moment for about 2%. That's been quite interesting rates, though still below inflation, but at least at the level where the Bank of England is targeting inflation to be. So that's something to be aware of there. But then I think the big thing about all this about inflation as well and interest rates is what is the effect of this going to have on investments and your portfolios, because it's the return that your portfolios are going to achieve, especially in excess of inflation, that's also going to help determine whether your financial plan is successful. And we're doing the work behind the scenes to make sure you're in the right portfolio and the right strategy with the right people to make sure you achieve the returns that you do need. So now is going to be a good time for me to hand over to Shane, who is the Chief Investment of U Asset Management. And a number of our clients are in their portfolios, both on the active range and the enhanced passive range from there. Shane's talk is titled Time to Get Your Bearings Straight. And hopefully he's going to answer some of the questions about what's been going on with the stock market and what needs to happen next.
Brilliant. Thank you, Andrew. Just going to share screen. Welcome, everyone. So going to go through what the current macro environment is. So the environment we currently find ourselves in then, and then how that has affected performance, both short term and long term. Then, as Andrew said previously, we're going to look at the crystal ball and see what the future holds for us and what are the things that we're most concerned about at this moment in time. But most importantly after that is understanding that It's okay to feel fear and greed during your investment journey. So we're going to go through examples of how you could become better investors by purely understanding the emotions, being in control of those emotions, and staying invested for the long term. But please ask questions as we go along. This shows the MSCI World indices for this year, and you can see it's been extremely volatile. Now, we always knew that 2022 was going to be a volatile time. We're moving from an environment of economic stimulus from both central banks and governments to one that was going to start squeezing back on that stimulus. We're going to sort of reduce quantitative easing, and there was going to be rises in interest rates. That brings with it a change in leadership among what funds are going to do well, what styles are going to do well. So there's always going to be a rotation away from the growth area that did well in 2020, 2021 to probably more value styles. That was fine. We knew there's going to be volatility. You can assess that. But obviously what we also had was Russians' invasion of Ukraine, which really muddied the waters and made everything a little bit more volatile than it probably would have been. And you can see here from the up and down arrows, you've got a volatility over the first sort of 6 months of the year that we would have quite looked at and said, well, that looks more like 18 months worth of volatility. So it has been incredibly active there. And that creates opportunities as well as looking to, capture the upside as well as trying to soften the blows on the downside. But it has been extremely volatile. And what we're going to have for the first time since 2015 is back-to-back negative quarters. And that's not necessarily a bad thing. And we'll talk about that later on in the staying invested slot. How did Russia increase this volatility? Russia is a big producer of a lot of the commodities that are required for food and energy. If you look at it as a whole, it's not a huge amount for the EU, and EU is probably the worst hit here. But when you look at the key elements, fertilizers, energies, Russia is a huge major player, as well as Ukraine for food as well. Couple that with China, who are currently having a zero tolerance towards COVID. So anytime there's an outbreak, there's an immediate shutdown. We still have supply chains that are muddled, and that's why we're seeing an increase in inflation. Inflation is probably our biggest concern at this moment in time. And the problem is central banks are behind the curve. We should have been seeing interest rate rises, arguably, this time last year. What we're doing is seeing the Federal Reserve and the Bank of England playing catch up. Now, the Bank of England, to be fair, is being a little bit more subtle about its rate rises. It's only using 0.25% each time, but it has raised 5 consecutive meetings. So we're up to 1.25% for interest rates in the UK. And that's on the back of a new high for UK inflation. Now, the headlines for inflation have certainly been high and have taken all of the attention. But if you were to read underneath that, there are certain elements in that inflation basket that are starting to roll over, starting to come down. So we could be in a situation where we see inflation maybe peaking in the next couple of months, but then rolling over and coming down. But don't always look at that headline. Have a look underneath and see where the other components of inflation are. Now, that could look good for the central banks because it will look like they've done a good job bringing inflation down. But ironically, even if they don't raise rates anymore, we think inflation is coming down. The biggest concern we have, though, is that interest rates are raised too high, too quickly, and will cause the next recession. That was the big wobble in the markets back in 2018 with Jerome Powell, the head of the Federal Reserve then and is at the moment, came out and said they're going to raise rates a lot quicker than expected. That caused a big drop in the last quarter of 2018 until Jerome Powell came out and said no rate rises in 2019, which gave us that next leg in the rally that we saw from the global financial crisis. What we've had this year is a lot more rate rises than was fully anticipated back in December. I think we're up to something like 12 for this year, when at the beginning of the year, we're only anticipating 3 rate rises. How does the Fed communicate that to us? Well, here we have the dot plots, and this is a Each dot represents an estimate from each member of the Federal Reserve where they think interest rates are going to be. If I can get this to work here. So here at the end of 2022, the average rate they think is going to be around about 1 3/4, 2%. You can see here at the end of 2023, it's coming up to around about 2.5, about the same for 2024. But the long run, roughly 2.25%. If you put shapes around those, you can see here that where the shape is a little bit more like myself, short and wide, and if you take away the two outliers up here, you've got a very good predictability for long-term interest rates here at around about 2.25%. When it's short and narrow,
22, 23, and 24, we can sort that then now. Sorry. And narrow. Yeah, I was just double checking on the one. Yeah, it was a slide before which you finished on.
Oh, perfect.
Which one about the interest rate rises. So when I said Fred, sorry, it wasn't that, but yeah,
cool.
It was only the first few minutes. I had to stop the recording bit on it from that. Stop recording.
The shorter and the fatter the shape, there's more predictability. So if you look at the long term here, the predictability there is, yes, they think long-term interest rates will be around about 2.5%. Great, which ties in beautifully with Andrew's long-term projections for inflation in his modeling. End of 22, 23, and 24, very thin and narrow, which means there's not much consistency, not much collegiate with the guesses. They don't really know where it's going to be. Compare that with December's guesses, and you can see how quickly those interest rate projections have gone up. Blue was December, amber was March, and you can see a huge change. Now let's overlay last week's. So we had the June projections. You can see over the short term, huge amount of increase in projections there. They expect interest rates to be around about 3.5% by the end of the year. That would mean another 1.5% rate rise in the US in the next 6 months of the year. We think that's over-egging. What you can see there, though, they expect it to stay there for a couple of years before coming down to the longer run average of still around about 2.5%. So the long-term run average is still consistent. It's just this short term, and that's the problem they're having at the moment. So our biggest concern at the moment is policy risk from central banks. Have they got it right, or are they getting it wrong? So what has that done to the investment so far this year? If we look at the active models, we have active and we have passive models. It's probably no surprise to see year to date, and this is to the end of May. We'll get the end of quarter figures in a week's time. So look out for the quarterly review in about 2 weeks' time. And what we're showing you here is portfolios 2, 5, and 8, just a rough indication of where they sit. And obviously 4 and 3 sit nicely in between 2 and 5, and 6 and 7 sit nicely between 5 and 8 there. And you can see underwater for year to date so far. Volatile, the more risk you take, you can see much more volatile journey, but less than our peer groups and less than the markets, which is some solace, but obviously we're looking to provide real absolute returns for clients. Over 1 year, so from May to May, slightly underwater. If you go for longer term figures, 3 and 5 years, still positive returns. And we always say, please judge us by our 5-year numbers. And you can see here in the 5-year numbers, we have that drop in Q4 18 that I talked about, and then you have COVID here, and you can see the drop down in 2022. Will we get back to positive figures by the end of the year? Difficult one. It depends how inflation pans out on that one for us. I think we could have a positive Q3, maybe a positive Q4, but will it undo the work of Q1 and Q2? I don't know. We'll have to wait and see. Since launch, so it's good to refresh the memory, and we've been running these portfolios 17 years and 7 months. They're our long-term numbers. The biggest drop here, precipitous, was COVID. You can see this drop here as well. That was the global financial crisis, which was 12, 13 years ago now. If you overlay cash over the top of that year period, you can see the portfolio is outperforming. If you overlay inflation, portfolio 2 and above, beating long-term inflation. And if you include the FTSE 100 as that sort of bellwether indicator, portfolio 5 slightly underperforming, but that's only taking 50% as much risk as the FTSE 100. But portfolio 6 and above, outperforming the FTSE 100. So adding positive value as well as relative value as well. And it's a very similar proposition for passive as well. Passive doing slightly better over the year rather than active, but this period, the first half of the year, active doing slightly better. So this all going in tandem at this moment in time. But pleasingly, the 3-year and 5-year number still showing good, solid, positive returns. If we look at launch, they've been going 9 years and 2 months. So next April, they'll be their 10th birthday. All the portfolios outperforming cash and inflation. So they're the key metrics. And again, FTSE 100 over that period, portfolios 4 and above are beating that metric as well. So longer term performance doing particularly well. And it's one of those periods where you have to sort of just be comfortable with. There's going to be down periods, and be comfortable where there's going to be up periods as well. Which brings us on to the outlook. This is a chart showing you how our markets reacted before and after interest rate cycles. We're sort of in this period here where markets tend to perform negatively during interest rate rises. When those cycles are finished, you tend to get a more positive outlook thereafter. So we're in the eye of the storm at the moment, and that was always going to be the way because we've moved through this transitory period. Those products and funds that did well during COVID are now the ones underperforming. So growth, telecom, healthcare, real estate, they're all underperforming at the moment. Banks, financial services, value, energy, they're outperforming. So it's like a move from value from growth, whereas growth is doing well. We try and have a diversified portfolio to capture all elements of the market. So it's important that when the market turns, we're not left standing high and dry. We're participating in all these areas of the market. But the biggest concern for the market, and I've alluded to it earlier, was, and here's the main contributors to recessions. So the last 46 recessions we've had, what is contributing to those? And you see credit bubble, housing bubble, oil price shock. But there's one element that contributes most, and that is monetary policy tightening, raising interest rates. And that's the biggest fear in the markets at this moment in time. So are we near the bottom? I think we probably are, but the bottom might last for a bit longer. And that's where it's important to understand how you're invested and why you're feeling how you're feeling. So we've come up with a cycle of your emotions. You can see here, it ranges from optimism up to euphoria. It drops down to depression, panic, and capitulation. And then it rides back up again. And you're going to go through several of these cycles through your investment journey. It's important to realize, though, when you're feeling most euphoric, that's arguably the time of maximum risk. And when you're feeling most despondent, ironically, that's the time of maximum financial opportunity. And we overlaid the COVID cycle through these, so you can know how you felt through these. And these cycles can last a long time or they can last a short time. And in COVID, this area here, the point of maximum financial opportunity, only lasted about 6 weeks. Where do we currently sit? Well, at the end of the year, we sort of sat here. We were coming down this side here. We had central banks telling us they were going to raise interest rates. We had a transition from growth companies to value companies, and we had increasing inflation that needed to be tackled. Where do we currently sit? We sit in this area here, arguably the point of maximum financial opportunity. I really need to change that. It's a bit of a tongue twister for me. We have a rotation in those market leaders. We have an expectation for increase in rate hikes keeping going up, and we have inflation keep creating new peaks. Although if you read underneath the headlines, it is not as bad as the headlines make out. And on top of that, we had Russia invading, which sort of skewed everything.
Shane, maybe
yes.
A question that we've been asked by one of our clients on there with going back to where you were on the slide before and being at this sort of period of opportunity,
Yes.
potentially at the bottom, you know, with the recent sort of drops in values, do you feel there's any sort of bargains to be had in the sort of fund selection world?
Yeah, that's a really good question. We have a reserve list for every fund that we currently invested in, and we have a wish list as well of those funds that are really well managed, have really good pedigree, but for whatever reason are just too expensive. And what we've seen is a few of those funds that are on our wish list have dropped massively over 2022. One of those being Bailey Gifford Global Discovery, extremely good fund managed by Doug Brody. He's got a master's in molecular biology, and it's a really good fund. However, it was awfully expensive. It had done phenomenally well during COVID. It's now dropped something like 60% during 2022. And we're looking to invest in that now. So we're buying a really good fund at a fire sale price. So for us, it's about being patient and buying these funds as and when the price comes towards us. Nothing's changed in that portfolio. Doug hasn't changed the way he runs money. It's just that a lot of the stocks were at super high prices and they've come off now. So yeah, 1st of August, we'll be purchasing that within the model portfolios. So keep an eye out for Bailey Gifford Global Discovery. Problem is, bad times hurt better than good times. So bad times hurt roughly 2.5 times more than pleasure. And the bad times tend to be quite precipitous in their fall here. And you can see here the last, what have we got there? Last 9 bear markets, significantly large drops, happen very quickly. And, you know, it spooks clients. Good times tend to be more drawn out, last longer, and by such, because they're more drawn out, don't sort of feel as good as the downsides hurt as much. But don't underestimate the ability they have by recovering more than the drops you had. And you can see here, if you're investing since 1958 in the S&P 500, you can see here that there was more good times than bad times. And it's just being comfortable in the good times and not overreacting in the bad times. What do I mean by that? If we take this 20-year period here, how would you invest it over that? You come into the end of the rally, you've got .com here, you've got global financial crisis here, but you've got some good bull markets in between. Now, over that 20-year period, if you invested in the FTSE All Share, £10,000, how much would that have returned? You would have made 3 times your money. However, if you'd been spooked by those ups and downs and you missed 10 days, the 10 best days, by trying to time the markets, you halved your return. Miss an extra 5 days and you just about make a profit. And if you miss 25 days, which is less than 1% of your investment journey, you made a loss. And it's not just the 90s and the 2000s there. Every decade has the same phenomena. And it might be, look at the 1930s, it might be by missing the best 10 days, you make more of a loss than you would have done. So if you missed the best 10 days in the 1930s, you were down 80% rather than 40. I know that's not much of a solace, but it is a significant difference. Or look at the 90s. You would have made 186% by missing the best 10 days rather than double 316%. So it's just this phenomenon of staying invested is critical. Now, it's not always easy. And that's why, Lord Elson is here to help make sure you're keeping to your financial goals. I'm here to help reassure that we're keeping a long-term view. And we're always asked that, does timing matter? When do I invest? I'm sitting on cash today, Shane. Should I invest? And my answer is always yes, as long as you have a long-term horizon. What we've got here is portfolio 6, and we're going to show you what having a long-term or a short-term horizon means. Having a 1-year investment horizon, you could have had over 17 years and 7 months, a fantastic year of plus 41%, or the worst year, minus 29. Now that minus 29% year was April 08 till April 09, global financial crisis. Ironically, the following 12 months, April 09 to April 10, that was the 41% year. So if you're only investing for 1 year, timing massively matters, hugely significant. However, if you increase your time horizon to 2 years, the annualized returns start to come in. And you increase that to 5 years, and you eradicate negative returns, and you move through all the way through to 17 years, an example, and you can see the dispersion between the best and the worst significantly reduces. So as long as you're investing for the long term, when you start investing does not significantly matter. And more importantly, the difference between the blue and the gray here, that's the average. And you can see here for portfolio 6, the average is pretty consistent, around about 8% per annum. So with Andrew's investment horizon of 3%, we can give you 8% per annum in portfolio 6, or have historically done that, so significantly outperforming inflation. If we look at the FTSE All Share again, look at it in calendar years, you can see here that probability you have more positive than negative years. And if you have a run of negative years here in like the 2000s with the dot-com, then you have a series of significantly higher positive years. But even in the positive years, the market is a bit cruel. And my daughter calls these the measles chart. And it here is trying to catch you a cold. So if we look at 1987, we've got this dot down here, it's about minus 38%. That was Black Monday, 1987 in October. If you'd stayed invested for the whole year, you ended up in positive territory. So even when it looks the darkest, stay invested. You can either, like in 2020, end up with less of a loss, or like 2021, the lowest point was 0. We overlaid our own returns here for portfolio 6, and this is 17 years worth of returns. And you can see here a lot of the 0 points, a lot of the low points are actually 0, which is really important. And there's even more positive than negatives for our portfolio 6. And I've done this for all of the risk profiles. So if you want to look at your own risk profile, I know Andrew's got the data on that for you. Most importantly for clients, though, it's like, when am I going to get a positive return? And what we did, we broke down how often the quarterly returns are positive or negative. And what you have here is we have sort of 6 different buckets. We have on the positive side, 0 to +5, +5 to +10, and greater than +10. And then on the negative side, 0 to -5, -5 to -10, and worse than -10. And you can see here the majority of the buckets fall into this 0 to +5, which is really handy. And you can see the more risk you take, suddenly the lower they come and the wider the dispersion becomes, meaning you're taking more risk. If we look at portfolio 6 again, you can see here, these are all the quarterly distributions of returns. And we sort of say to clients, imagine you've got this sweet spot, but how often does your portfolio returns fall between +5 and -5, that dispersion? And you can see here, 69% of the time, those returns fall between +5 and -5. And if you look at all the risk profiles here, the more risk you take, the less it falls into that bucket. So it's sort of like your sleep at night. If you're in portfolios 5 or 6, more than 2/3 of the time, you know your returns are going to be between -5 and +5. You know as well on that, the third of the time, they're going to be actually better than +5 than -5. Which leads us to, Shane, how often can I expect a positive return? And if you only invest with us for a quarter, 73% of the time you can expect a positive return. But again, remember these 5-year number I said, treat us on our 5-year numbers. If you invest for us for 5 years, 100% of the time you can expect a positive return. Now, my boss doesn't like decimal points, and it's actually 99.9, but if you round up 99.9 to no decimal places, it's 100%. So it is actually 99.9. So for us, it's really important, particularly during this year of transition, to continue to stick to your financial plan, to manage expectations that, okay, we've had a very good period up to now. This is one of those fallow periods, and stick to your time horizon, stick to your attitude to risk. We expect inflation to turn over at some point this year. Now, that is an outlier view of us. That's not consensus by a lot of the markets. But there are things that are going to throw up spanners in the work on that. Will the war in Europe get worse or better? Will COVID, zero tolerance in China, will that mend the supply chains, or will that continue to wreak havoc with supply chains? So there's still a lot of unknowns out there, but going forward, we're very confident in the long-term returns of our portfolios.
Shane, that's sort of great going through that for us. Couple more questions that would be helpful
fire away.
to answer is often when markets are falling, then that's a time when people feel, well, okay, they're falling now. Should you be doing something about it? What are you doing to make changes to mitigate any falls, or does that bring more dangers by doing that?
Yeah, that's a really good question. What we try and look at is any particular time not to take over-egg the pudding, as it were. We want to make sure we have appropriately diversified portfolios throughout the risk profile. We added to risk in 2020 when the COVID gave us an opportunity there. We didn't add additional risk throughout 2021, whereas a lot of our peer groups were running at higher equity allocations than we were, which in relative terms meant we've done better in the downturn than a lot of our peers, although that's solace to a degree, but we still have negative returns, but less than the marketplace.
Yeah,
what we're looking at now is picking up those opportunities where we are in better root health than a lot of our competitors, but making sure we're diversified. So things like high yield debt, things like China bonds done particularly well, not China equity, but China bond, commodities. Our commodities exposure has done very well, and making sure we've got a spread of styles within our equities.
Yeah. Okay. And I think you're right. Even though you may not have lost more than others in your peer group, it still doesn't feel good.
Oh no, God.
At that time when it's a negative bit. But the hope is, as you've sort of alluded to already, that we're near the bottom of the market, and when some of the new figures come out, that we'll see sort of more positive quarters coming in, and hopefully it will pull back this year.
Yeah.
If we can end this year at zero, I think we'd be happy at the moment. But
yeah, flat year would be amazing. And I think one of our overweights is UK equities, because I think of all the central banks, I think the Bank of England, as much criticism as it's getting for not raising rates quickly enough, I think it's been really prudent, and I think their approach could bear good fruit by the end of the year.
Yeah, and the experience, you and I have been doing this job for 20 plus years, is often what happens in times like this is the market overreacts.
Yes.
And goes too far, and then it sort of wakes up, smells the coffee, and then reassesses, and then there's a bit of a rebound and a reset. The worry is part of what you said already. And I know we've been talking about this for like almost a couple of years now, that the danger was central banks making a mess.
Yeah.
And making a policy error, and the concern is the US might be in that space, and maybe the Bank of England has been a little bit more cautious and maybe a little bit more correct once we actually get through this cycle.
Yeah, you're right, and it's sometimes the time to take a little bit more risk is when you see really good products, really good funds, really good asset classes dropping far below than you'd expect them to. Things like Bailey Gifford Global Discovery. And that gives us a bit more confidence to be adding a little bit more risk. Not yet, but at some point. So it's difficult to do, Andrew. It really is, because you got to be not too fearful when things are really terrible, and absolutely not too greedy when things are flying through the roof. So yeah, this time I know it might sound counterintuitive, but we're looking at the markets going, they have dropped. A lot of the froth has come out. Gosh, this time last year we'd have been talking about GameStop and meme stocks and Bitcoin and everything else. They have absolutely dropped through the floor. So a lot of the froth has come out of the marketplace, and I think the market's in a better position now than it was arguably 12 months ago for longer term returns.
Yeah. Okay. Brilliant. And one thing another question I think I'll deal with myself is one of the regulatory requirements that we have is that if during a reporting period, so typically a quarter, an investment falls by more than 10%,
yes,
then there has to be an email that goes out or correspondence that goes out to inform client it's fallen by 10%. The whole profession feels this absolutely crazy idea, because ideally clients have been taking a longer term view. And even the fact of getting quarterly valuations, I think, is a time to go, and people should look at it once a year, every 6 months, the most, because you need to just let it do what it needs to do. And when you send out a letter saying it's fallen by 10%, we're fortunate now most clients don't get in touch with us because they've been through a period and a cycle and understand the investing. But those that do, we say, what should I do? Stay just as you are. You've still got the same long-term horizon that you're planning for. The bit that you mentioned about doing anything different, missing those best days, you're going to miss the best days by coming out. So the answer is ignore the email. And it's a frustration when, you know, that they have to go, because I know for our team, and it will be the same for you, we lost a couple of days the last couple of weeks just in sending those emails out to tell people really ignore it.
Yeah, our investment admin team was inundated, and yeah, you're right, Andrew. It's quite a bizarre twist that the regulator forces us to send out 10% drop notifications. It'll be interesting if we could send out 20% increase notifications to tell clients, hey, take some profit, don't get too carried away. But you're right, and it's one of those things, you know, as humans, I think we're programmed to react. And sometimes a reaction of do nothing is one of the most powerful things you can do, although it feels incredibly uncomfortable. And so that emotional journey, that cycle of emotions, it doesn't help when the 10% drop letters come out. We're going to have, for the first time since 2015, back-to-back negative quarters. And it's a time to reevaluate the narrative. It's time to reassure and remind clients that this is a long-term investment journey, because, you know, if you do miss those best 10 days, it could have a crippling effect to your long-term returns.
And that's about my own feeling as well. I feel the market is going to recover, and when it does, it will be quite quickly.
Yes.
You know, people are waiting for it to recover to do something. By the time it starts recovering, by the time they get around to doing something, they will have missed it.
Yeah.
Yeah. Another good
There's a question from Suzanne, I saw.
Yeah. A question from Suzanne about, is it time to look at sort of alternative investments, commodities, gold, things like that?
Yeah. Yeah. When we're in elements like this, two of our key asset classes are property and real assets and absolute return. And within property and real assets, we've got things like managed futures, which is a real flash name for things like just betting on the directional move of the markets, and also commodities. And they've done exceptionally well for us. Not necessarily gold per se, but other things like cobalt, platinum, lithium, a lot of things that are construction into electric batteries for electric vehicles. That's going through the roof. There's a lot of construction still going on, so cement and copper and steel and things like that. So commodities is looking particularly good for us at this moment in time. Not necessarily gold per se. I think gold has always been perceived to be that safe haven in times of rising interest rates. It hasn't, and inflation, it hasn't done as good as it has done in the past, but it's not saying something we're going to ignore. But yeah, commodities and other different asset classes, something we're looking at in great detail at the moment. Yeah,
super. Well, thank you very much for that, Shane. I'm just going to move on and just finish off with a couple of little last things to sort of share with people from here then. So again, I've got to get my computer working now. So just a little bit about what's next. So if I can remind you, as you sort of exit the webinar, when it closes in a few minutes, you will get the option to fill in the survey. It will only take you a few moments, and we'll be very grateful for your feedback and finding out what else you would like us to do to help and support you on your financial planning journey. We are planning to do another one of these events, hopefully in the autumn, and hopefully at a face-to-face. We just need to get all these weddings and other events out the way, so that the hotels and places that we had in mind to use have got some space which we can use. And then finally, just you know, the summer holidays are now upon us. I hope for most people that you get to spend some time on a fantastic holiday and not in an airport queuing for your holiday. Just a little bit of a heads up that Sarah and I are away for the next 2 weeks, learning to sail a boat in Greece. So if you hear of any sort of large-scale disasters, sort of shipping issues, that was when Connor got hold of the helm and was steering, and me and Sarah will be trying to keep him off it. But the team will be here for the next 2 weeks. If you do need us for anything at all, Sarah and I are here for Thursday and Friday this week from there. So I think really just want to say thank you very much to everybody. I hope you've really enjoyed today's webinar from there, found it useful. Thank you very much to Shane for the time that you've spent with us. And we will be sending out a recording of this afterwards for you to be able to see. So
Brilliant.
take care, everybody.
Thank you, Andrew. Thank you, Sarah. Thanks, everyone.